AI is scaring investors in America. So why is China buying? That shouldn't happen. If artificial intelligence is threatening software margins in the US, if investors are selling companies that look exposed to automation, why are Chinese AI stocks doubling? Same technology, opposite reaction. That's not sentiment, that's structure. In the United States, AI is being priced as a threat to profit pools. For 20 years, American tech built enormous margins. Software subscriptions, ad networks, advisory services, platform fees, high margin, high pricing power, high expectations. When AI arrives in that environment, investors don't see opportunity first. They see compression. If AI makes coding cheaper, if it reduces headcount, if it lowers the value of human expertise, margins shrink. And when margins shrink in a mature, high-profit system, multiples fall fast. That's the scare trade. Now, look at China. China has not been living in a high-margin world. Domestic demand has been soft. Inflation has been low. At times, flirting with deflation. Property slowed, pricing power tightened, corporate profits compressed. When you operate in a low-margin system, efficiency is not a threat, it's oxygen. If AI reduces labor costs, optimizes logistics, improves supply chains, automates customer service, those savings don't destroy profit pools, they rebuild them. That's the difference. America is defending excess profit. China is trying to restore it. And there's another layer. Scarcity. In the US, the most famous AI firms aren't even public. Investors can't directly buy them. But in Hong Kong, newly listed pure AI model companies suddenly exist. When capital finally has something clean to buy, money rotates aggressively. New model release. Stock jumps. New benchmark ranking. Stock jumps. New analyst forecast. Stock jumps again. It feels like momentum, but underneath it, there's insulation. China's AI ecosystem is more closed. Foreign large language models have limited access to the domestic market. That gives local model builders a clearer runway, at least for now. Less external competition, more domestic capture. So investors are not pricing disruption first. They're pricing penetration. But here's where it gets interesting. AI doesn't stop at borders. If artificial intelligence can compress margins in the US, it can compress margins in China too. It just shows up later. And if China's rally is built on margin restoration, those earnings need to arrive. Because valuation expansion without revenue growth doesn't hold. So what you're watching isn't hype versus fear. It's two different economic starting points reacting to the same machine. A high-margin system pricing downside. A low-margin system pricing upside. Eventually, those two narratives collide. Because earnings don't care about sentiment, they care about math. And when the math shows up, one side will discover it wasn't early. It was wrong. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.